You are listening to The Vocal Technologist. Spoken tech for your ears.
A $53 billion bid to swallow PayPal. Let me explain. Welcome to Vocal Technologist, where we get into the guts of the smartest notes on our desks.
There is just an absolute mountain of capital shifting beneath our feet right now. And the sheer scale of the numbers is almost hard to process.
Oh, it's heaps of money.
Right. We're watching the entire financial architecture basically get rewired in real time.
We're talking about staggering figures here, and our goal is to really pick it apart. We want to suss out the massive financial bets being placed on AI infrastructure, the brutal battle for consumer checkout, and the regulatory lines that are being entirely redrawn.
Yeah, it's a lot of ground to cover.
It is, but we're going to walk through it piece by piece so you can see how all these invisible wires connect.
And it connects right at the highest levels of global finance. Let's start with that staggering number you just mentioned. Stripe and Advent International have reportedly offered $60.50 a share to acquire PayPal.
Which, that values PayPal at over $53 billion, right?
Yeah. Exactly. And it's backed by roughly $50 billion in committed bank financing. So this proposal would basically give Stripe and Advent equal ownership of the company.
I just need to pause on that for a second because it's massive. You've got Stripe, which, started as this incredibly sleek, developer-friendly payment processor, like the absolute darling of Silicon Valley.
Yeah, the back-end plumbing.
Right. And they are trying to absorb a legacy behemoth like PayPal. Why take on that kind of corporate baggage?
Well, it reveals how rapidly the payments sector is accelerating toward consolidation. Firms are just desperate for scale. Like you said, Stripe dominates the back end for developers, but PayPal owns the consumer relationship.
Oh.
They want that stronger position in checkout. They want Venmo. They want the crypto capabilities. And crucially, they want to capture cross-border payments.
That makes sense.
But, the quiet driver behind a deal this size is the hunt for AI-driven efficiencies. To run global financial networks at that planetary scale, you need predictive models, fraud detection, and automated routing that, frankly, only advanced AI can provide.
Right. Which brings us to the part nobody's really saying out loud. To get those AI efficiencies, you need raw compute.
Yes, you do.
You need massive amounts of graphics processing units, or GPUs. And this is where I was genuinely surprised by what's happening in the broader markets.
You're talking about the Kalshi news.
I am. So Kalshi is launching a forward curve for AI compute costs. They're using prediction market contracts tied to future GPU rental prices. When I first read that, I had to read it twice.
Which is fascinating when you think about the mechanics of it. AI infrastructure spending is growing so aggressively that computing power is starting to trade exactly like a raw commodity.
Wow.
Yeah, it's moving from a tech product to an industrial resource.
So here is the analogy that helped it click for me. Think about airlines, right? Qantas or Delta. They can't just hope the price of jet fuel stays low.
No, they have to buy futures.
Exactly. They hedge against the price of jet fuel so they know they can operate profitably months down the line. And AI companies are now in the exact same boat with computing power.
Precisely.
If you're building a massive language model, you have to hedge against the cost of renting GPUs. So are we at the point where computing power is officially the new oil?
Functionally, yes. Without access to massive clusters of GPUs, AI development just stalls entirely. It is the literal fuel for the modern tech economy.
That is wild.
And by creating a forward curve, Kalshi is laying the foundation for futures, options, and hedging tools. It allows companies to manage their exposure to compute prices.
Because you need stability.
Right. You can lock in your costs, which is essential when you're trying to build out a multi-billion-dollar AI product. You just can't have your core operational costs fluctuating by 40% a month.
Which brings up a pretty wild consequence. If GPUs are the new commodity, the platforms that are making these markets, like Kalshi, are suddenly worth an absolute fortune.
Oh, they're commanding valuations that are completely rewriting the rules of decentralized finance and prediction markets. How you value these market makers is becoming one of the most debated topics in tech finance right now.
Well, let's compare the two heavyweights here, because they have entirely different philosophies. You've got Kalshi on one side and Polymarket on the other.
Right. Kalshi is reportedly raising capital at a $40 billion valuation.
$40 billion. That is like 8 times its valuation from 18 months ago.
Yeah.
And it's about double Polymarket's valuation, which is sitting around $15 billion. I am really struggling to understand the massive gap there.
The divergence in those valuations comes down to entirely contrasting business models. So, Kalshi operates as a CFTC-regulated exchange.
Okay.
Because they play strictly by the rules of the U.S. Commodity Futures Trading Commission, they can legally charge a fee on their platform. They take about 1% per trade.
Which translates to around $2 billion in annualized revenue. So that's real, tangible cash flow.
Correct. Now, contrast that with Polymarket. They spent years running a growth-first model. They charged nothing, zero fees.
Right, just getting everyone on board.
Exactly. They built massive user adoption and volume by being totally frictionless, and now they're leaning on a data deal with ICE and a planned token launch to eventually capture value.
Okay, I've got to push back on Kalshi's numbers, though, because this feels incredibly dodgy to me. You look at that $40 billion valuation for Kalshi, and then you look at where their volume actually comes from.
You're looking at the sports contracts.
Exactly. Roughly 65% of Kalshi's trading volume is sports contracts.
Yeah, it's a huge chunk.
And right now, there are a dozen U.S. states actively trying to ban those exact contracts. So they're commanding a $40 billion valuation that basically hinges entirely on them winning a likely Supreme Court case.
It's risky.
Are they having a lend? Like, that seems like a massive house of cards to me.
It's a phenomenal amount of regulatory risk to price into a single company, I agree. But the reason investors are willing to stomach that risk and attach that massive valuation is because of the moat.
The moat being the regulation.
Yes. Building a CFTC-regulated market from scratch is agonizingly slow and expensive. It takes armies of lawyers and years of lobbying. Kalshi did the hard yards.
Ah, I see.
If they win that Supreme Court battle, they have a government-sanctioned monopoly on legally trading on real-world events in the U.S. Polymarket has the growth, but Kalshi is betting that regulatory compliance is the ultimate competitive advantage.
Okay, that makes sense. It's a high-wire act, but the payoff is total market dominance. The winner just takes the entire infrastructure layer.
Exactly.
So billions of dollars are flowing into AI compute. Billions more are flowing into the markets that price that compute. But let's look at the actual application. What happens when companies deploy all this incredibly expensive AI?
This is where the reality of the technology hits the friction of human organizations. We tend to think of AI as just a software upgrade.
Right.
You know, a new tool you install, like a better spreadsheet, and suddenly everyone in the office is 20% more efficient.
But it's not just software.
Not anymore, no. AI tokens behave far less like traditional software and much more like an infinitely scalable workforce.
Man, this concept from the A16's research really stuck with me. They framed it as a massive trap. They said, you just hired 1 million bad employees.
Spot on. Think about how a typical mid-sized company operates. You have undocumented processes, miscommunications, siloed data,
Oh, yeah.
and just a certain amount of wasted effort baked right into the corporate culture. It's the friction of doing business.
Right. So if your internal processes for something like, I don't know, expense reporting are a bit ordinary,
Yeah.
giving them infinite scale doesn't magically solve the underlying problem.
No, it makes it catastrophic. If you have poor management or unclear instructions, an AI agent doesn't stop to ask for clarification.
It just goes.
It doesn't have the common sense to say, wait, this doesn't look right. It executes that flawed process at lightning speed. It amplifies your organizational dysfunction. You go from making one mistake a day to making 1 million mistakes a second.
Wow. It's the ultimate magnifying glass for corporate incompetence. You automate a bad meeting, and suddenly the AI has scheduled 10,000 bad meetings across the entire enterprise before lunch.
It's a nightmare scenario.
It really is. Hey, if you are keen on untangling these massive shifts with us, make sure you turn on notifications for the show.
You know, the companies that will actually benefit from this infinite workforce are the ones that strip their processes down to the studs first. They have to build highly specific, trusted applications with strict guardrails before they let the AI loose.
Which perfectly explains where traditional banks are stepping in. They're looking at this wild, chaotic AI capability and trying to play matchmaker between it and your actual wallet. Visa released an AI assistant specifically designed for banking apps.
And the data backing this move is really compelling. Research shows that roughly 66% of Americans who use generative AI are already turning to it for financial advice.
They're literally asking chatbots how to budget their groceries.
Yes, but there is a major trust deficit when it comes to third-party AI startups handling financial data. Consumers overwhelmingly view their legacy banks as the most trusted institutions to safeguard personal information.
Obvious.
In fact, 85% of consumers say they're willing to share even more data with their bank if there's a clear AI-driven value proposition.
So Visa's play is basically offering this AI financial assistant to banks as a white label service. The bank plugs it into their existing app, and suddenly you have a conversational bot that understands your cash flow and gives personalized insights.
Exactly.
But I have got to question the trust factor here. It makes total sense that I trust my bank to lock up my data securely in a vault. They've been doing that for centuries.
Right.
But do I actually trust an AI chatbot sitting inside that app to tell me how to invest or spend my money?
That is the primary hurdle. Trusting a bank for data security is entirely different from trusting a generative algorithm for financial strategy. But the bet here is that the proximity to your secure data creates an illusion of competence. If the AI lives inside the bank's walled garden, consumers will instinctively assume it's as reliable and highly regulated as the bank's own encryption protocols.
Wow. And this isn't just happening at the retail banking level. The high net worth space is getting aggressively rewired too.
Oh, absolutely. Look at Flex. They're an AI-native private banking platform tailored for mid-sized businesses and high-net-worth owners.
Yep.
They just raised $70 million at a $1.2 billion valuation.
And they're planning to double their headcount and go global with that cash.
Right, because they recognize that mid-sized businesses are often completely underserved by traditional fintechs, which usually focus on microtransactions, and regional banks, which often lack the tech infrastructure. By building an AI-powered platform from the ground up, Flex is automating the bespoke white-glove services that used to require a floor full of private wealth managers.
So while AI is trying to give us high-end financial advice, the actual literal mechanics of how we buy a sandwich are being rewired right under our noses. And this is where we get into some really clever strategic moves.
You're looking at Block.
I am looking at Block. This move is sheer brilliance. Block is rolling out this neighborhoods program. They're linking Cash App's 59 million monthly active users directly with Square's 4.5 million merchants.
Starting primarily with local food orders, loyalty rewards, and pickup options.
Exactly. Think about how a typical food delivery order works right now. You use a delivery platform like Uber Eats. That platform charges the restaurant a 20 to 30% commission just to facilitate the order.
It absolutely crushes the merchant's margins.
Yes. So Block is basically building a closed-loop economy to bypass that entirely.
They're cutting out the middleman by leveraging assets they already own.
Yes. For years, people wondered how Block was going to justify owning both sides of the coin. Now we know. They're plugging their massive consumer asset Cash App directly into their massive merchant asset Square.
It's seamless.
The consumer opens Cash App, orders food from a Square merchant, and Block processes the whole thing natively. No external delivery app skimming 30% off the top. No external credit card rails taking a swipe fee.
It's a textbook example of network effects, and it's a massive Trojan horse strategy. Block is capturing the engagement, the consumer data, and the payment volume on both sides of the transaction.
It's so smart.
And it's not just the mechanics of ordering that are changing, it's the mechanics of credit at checkout. Buy now, pay later, or BNPL, is entering a completely new phase of maturity.
It used to feel like the Wild West of consumer credit. You can just click a button and split a payment with zero friction.
It really did. For years, the appeal of BNPL was that it operated largely outside traditional credit strictures. Consumers got a simple, interest-free way to spread out payments without a hard credit check, and merchants got higher conversion rates at checkout.
Everyone wins.
Right, but the regulatory net is finally tightening. Governments are catching up to the technology.
We're seeing this happen in the UK right now, aren't we?
Yes. The UK's Financial Conduct Authority, the FCA, is officially bringing deferred payment credit under strict regulation. This is the short-term, interest-free credit product that most people associate with BNPL.
So what does that actually mean for the companies operating there? Like if you're offering BNPL in London tomorrow, how does your business change?
Well, it means you have to treat these microloans with the exact same compliance rigor as a traditional credit card. You have to run affordability checks, provide highly standardized, clear disclosures, and implement robust consumer protections.
Wow.
It significantly raises the cost of doing business, but it also legitimizes the product in the eyes of the broader financial system.
And despite the regulations, the product itself is still expanding globally. It's moving from the screen to the pocket. ID Finance launched a BNPL debit card in Spain and Mexico.
They call it Terron by Plazo.
Right. It allows customers to make online and in-store purchases with flexible payments baked directly into the physical card. It's not just an online checkout button anymore. It's a piece of plastic in your physical wallet.
Which is the ultimate goal of all these financial platforms. They want to be the default layer of trust and utility in your daily life. But there is a broader pattern emerging here. We're seeing governments globally rushing to build fences around this innovation.
Yeah, they really are.
As we see with the FCA in the UK clamping down on credit, or Kalshi waiting on the Supreme Court to bless their market, or Stripe having to navigate antitrust to swallow PayPal, all of this financial innovation eventually hits the brick wall of government regulation.
Which perfectly explains the massive legislative push we're seeing in the U.S. with the Clarity Act.
Right. The Clarity Act is a broad crypto market structure bill. It aims to establish a comprehensive, nationwide regulatory framework for how digital assets are classified and traded in the United States.
So it's essentially the government trying to define what is a security, what is a commodity, and who gets to police it.
Exactly.
And President Donald Trump called on the Senate to pass the bill in honor of the late Senator Lindsey Graham, throwing significant political weight behind it.
Yes, and looking objectively at the mechanics of the legislation, the bill has support from the White House, and it has substantial backing from major cryptocurrency companies. Those firms are desperate for clear federal guidelines so they can build products without constantly looking over their shoulder for enforcement actions.
But there is notable structural opposition as well, right? This isn't a universally beloved piece of legislation.
No, it's not. Traditional legacy banks have voiced serious concerns about the framework. Their argument is rooted in the fear that it creates a parallel, lightly regulated banking system that could bypass them entirely, threatening their structural dominance.
What?
Alongside them, you have prominent labor groups opposing the bill.
Wait, why are labor groups involved in a crypto bill?
Their core argument is consumer protection. They argue the framework lacks sufficient safeguards against systemic risk, potentially exposing retail investors and workers' pension funds to volatile, unregulated financial engineering.
I see.
And because of these concerns, the bill is also opposed by several Democrats in the Senate.
And Senator Graham's passing fundamentally changes the map on the Senate floor.
It does. It narrows the Republican majority. When you have a tightly contested, highly complex bill with heavy opposition from legacy financial institutions, labor, and a divided chamber, a narrower majority mathematically complicates the path to securing enough votes for passage.
It's just a pure numbers game on the Senate floor at this point.
It really is. It's an incredibly delicate legislative balancing act, and it serves as a stark reminder of the ultimate bottleneck in tech.
Yeah.
You can build the most advanced financial infrastructure in the world. You can commoditize AI compute. You can rewire local consumer checkout. You can build infinite digital workforces, but it all remains tethered to the reality of legislative math and regulatory approval.
It's like the lightning speed of technological innovation is colliding head-on with the deliberate, methodical pace of government oversight.
Exactly. So we're left with this incredible tension. You know, if compute is the new oil and private markets like Kalshi are trying to price it, the next logical step is national security.
Oh, wow.
We might start seeing sovereign governments bypassing these private markets entirely, choosing to build their own national strategic AI compute reserves, just like they do with petroleum, rather than relying on a fragile web of tech companies.
The plumbing of money is being entirely rebuilt while we're still using the taps.
Right.
We'll have to see who ends up controlling the water. Vocal Technologist, see you soon.
Spoken Tech for your ears.